let's look a little bit more into the issues that have been presented, and I would like to start with Klime. Your study was produced by academics, you as an academic, Xadia also as an academic. And the question that I have for you, is this not for the moment, these deliberations about ESG investments, an academic issue, in the sense that are there sufficient investment opportunities? If insurers want to invest, are there opportunities?
My short answer will be yes and no.
That's a very clear answer.
And now I will elaborate more deep on this question. But what I will say, what I will justify, or I will explain, it will be from the perspective, I will focus more from the non-EU countries. Because the ESG topics are very relevant. The ESG risks are on the very high scale. Therefore, what I would like to discuss and to talk is if the insurance industry, from the investment side, in the non-EU region, can give some contribution to manage with the ESG consequences and to manage with the ESG risk. The investment policy is influenced by regulatory development per se. This is the most important factor. Then the stakeholders' expectations. Stakeholders meaning the shareholders, stakeholders meaning the policyholders, the government, the state, the NGOs, and many other activists who are dealing especially with the environmental and social issues. And of course, the third very important factor is that we can recognize that there is a growing recognition of the importance of the sustainability of the sustainable investment activity of the companies. Now let me give you some info about the regulatory landscape. The regulatory constraints are very high, especially for the countries who are still on the Solvency I regime. We are more, let's say, rule-based, and we have very strict criteria on the investment class. So, regulatory constraints, but also what kind of instruments we have in the place. All the governments, especially in the Balkans, they have strong commitments on achieving millennium goals, of achieving or to come close to the European Green Agenda. Even 2 years ago, the European Commission have decided to offer to Western Balkan countries, for those who are not familiar, are a group of 6 countries: Bosnia and Herzegovina, Serbia, Montenegro, Albania, Kosovo, and Macedonia. And they provide with 1.25 billion euro in supporting and to transfer the economy to come closer to the and to achieve the goals of the European Green Agenda. And those funds actually are planned to go for clean energy, safety, sustainable transport, private sector developments, climate change, and many other aspects. So what means this? How we can make a good balance with the insurance industry? If the insurance companies like to invest or to enter into public-private partnership or to invest in some of these government support projects, just to borrow the money, they cannot because of the regulatory constraint. So this is very important burden. And I will give you a concrete example where I was also personally involved as a CEO of the VAG subsidiary company in Macedonia. One of the most pressing risks in Macedonia, especially in the capital city of Skopje, is the air pollution. Air pollution affects, and it's a main reason for having a lot of debt. It's proved by some investigation. The mayor of city of Skopje present some solution how to fight against the air pollution. For some of the solution, we need investment, and the city of Skopje like to borrow the money from some international finance organization. It could be EBRD or European Investment Bank, but you borrow the money with the rent. You pay the interest rate. And then I said, okay, let's do something jointly. We have the money. Why to put in the government bonds or in the bank deposits as the two most pressing investment vehicles in our financial system, which is allowed by regulation? And instead to borrow the money with the same interest rate, we will provide you with the money. Especially the life company are very much interested because of the life protection and the debt we have caused by air pollution. And then how this could be financed? Maybe by municipality bond. But the city of Skopje cannot issue municipality bond because, again, it's a regulatory obstacle. So regulation I will put on the first place. Then there are a lot of opportunities when we mention this impact investing. Impact investment meaning to create positive social and environmental change, but to have measurable outcomes. So this is one example of impact invest. So regulatory obstacles are number one. Then what is positive, that we have more growing awareness, and even we have market demand. I was surprised that some NGOs come to me as an NGO, but also as a policyholder, to ask me where we invest our money from technical reserves, so from the capital. So I said to government bonds and to the bank deposits. Let's do some positive screening, and we have some projects related with renewable energy, with affordable housing, with healthcare, education, agriculture, sustainable agriculture, and also microfinance. And again, we have constraints, which is come to the first obstacle, regulation. So all this statement from my side, meaning that we have awareness, we have sufficient funds to put our assets in the sustainable investment class. We also have knowledge on selecting the or to create so-called integration strategy, like positive and negative screening. We know how to select what is the positive screening, what is negative screening. We know how to choose the best class investment, but we don't have freedom to invest. So I will come that the regulatory burden is the number one obstacle. So after that, maybe things will be much better. I try to address this question to the government. There is always some commitments, okay, but always some other political priorities are more important, especially in our region, which is very fragile because of the geostrategic developments, the war in Ukraine, still the potential risk with Kosovo and Bosnia and Herzegovina. Maybe you can hear in the news that very, very fragile situation in this part. So therefore, the sustainability issue, the ESG, will be not on the higher priorities.
Okay. Thank you very much. I think it's very interesting that you approach this question with pointing out the regulatory reality still in the countries that are under Solvency I. You see that under Solvency II, where we introduced the freedom, that now more and more that freedom is being reduced by political considerations of moving in a certain direction. And you've seen how the impact of that was, for instance, in the United States. In the United States, you have a massive opposition in certain states. It's the blue or the red states, I don't know. The reds, I think. The red states against this interference of governments into the investment policy. Matti, you are fully in that picture because I'm going to ask you a very simple question. What would be your priority in the pension funds? Is it the investment return for the members of the pension fund, or is this the respect of sustainability?
Thanks, Karel.
Sorry for the question.
No, it's a key question. Of course, pension funds, as the basic duty is to provide for pensions, then the financial returns are key. And then it goes to the question, is then the consideration of these extra financial, that's the old terms, ESG, it will be called non-financial issues at one point. So ESG considerations, does it have an impact on returns? And then there are a lot of studies. I read a paper that had looked at 153 studies on this issue, and it's not conclusive. The fact is that ESG investments require data, and the data can be very expensive if it's provided by private companies, as it often is. Then you have to pay for it. Now, as Michaela mentioned, there is this European Single Access Point project. If that helps, that it would be publicly available data, but still, at the moment, doing ESG investments, you have to have ESG data, and that costs. So if everything else is the same, ESG investments will be more expensive, returns will be lower. And there are many studies that prove that ESG underperforms. On the risk management side, I think there are studies that prove that ESG doesn't improve the returns, but it improves the risk management. So it's a balance. So in this world, all of this is important. Both returns, you should not jeopardize the returns. You should have a robust risk management. And you also need to consider increasingly the views of the members and beneficiaries. And this has been surveyed, especially in the Netherlands, many surveys of whether people are willing to give up returns, to accept lower benefits in the end because of ESG. And many, especially older people, 50 plus, have been willing to give up. For example, if they've been asked, are you willing to give up 1%? They have been willing to give up 1%. So I think increasingly the constituencies, so members and beneficiaries, customers, clients, they are interested in ESG, genuinely interested. They want their money to be invested based on ESG criteria, sustainably. And then, of course, it comes to the question like how much do you sacrifice returns, or if you do, how much you do that. And then, of course, if you go into really like thematic investments, really impact investing for a cause, that will be different than your regular managing of a portfolio. You know that there are different cases. If you really are committed to some cause, then you're most likely willing to give that much more emphasis. So it's developing, but I would say that that's the situation at the moment.
It's very interesting because you mentioned this concept of fiduciary duty. Technically speaking, you know, if the members of the pension fund would not be in favor of a potentially lower investment return by the fact that the pension fund is investing in sustainable assets, they might potentially sue the management of the pension fund because they're not doing their job. So in that sense, this is a real issue. And I don't think the final answer, you put it clearly, there is no final answer to the question, are all sustainable developments, investment delivering a higher return? And that, by the way, is a major issue also on a personal level. If you, as the European regulation is saying today, that the people offering you investments must always let you choose whether you want to go for sustainable investments. But sometimes sustainable investments, as they don't deliver a good return, once you sign that you only want to invest in sustainable investments and there is no return, you have no money. You're losing money as I speak. So that creates problems also for the financial institutions that are offering these products. So this is a real issue. Another issue I wanted to ask you, Matti, is how do you deal with transition risk? Because we all know for sure now that coal and gas, and so it's not so good to invest in that. Although when we have a new energy crisis, maybe we'll change our views about that. We all agree that defense industry, let's not talk about that. But now, is it socially acceptable not to invest in defense industry? Because we need to defend ourselves. So how do you deal with this transition risk?
Yeah, it's an important issue, and like on the defense industry, our member Insurance and Pension Denmark some weeks ago came up very strongly saying that pension funds need to be able to invest in defense. And talking with the Dutch pension funds, it's a very nuanced debate. So yes, you can invest in armaments, but it has to be, you really need to know what you are investing in. You cannot invest in cluster bombs, but you can invest in something that is really acceptable. So really, I mean, the Swedish pension funds for a long time where sustainable investment, responsible investment really has a long tradition. The Swedish pension funds were for a long time of the opinion that an independent nation has the right to defend itself. Thus you have to be able to invest in defense. They did then change their mind, now they're changing it back.
Now that they're a member of NATO, yes.
Yeah, now they're a member of NATO and want to invest in defense. But in the transition risks, of course, climate change is really the big issue. And EIOPA conducted the first climate stress tests on pension funds a couple of years ago and discovered that, yes, there were both in bonds and 10% of the bond investments, 6% of the equity investments had serious consequences of the stress scenario in climate. But still, I think you also concluded that it was manageable, that the solvency, I mean, the financial situation, it was manageable. But this is a real risk for pension funds. And then, of course, they have to take all measures, doing green investments, engaging with the companies, educating, being transparent, all of this needs to be done. And then, of course, for us, what we have been always calling in the European regulatory and policy development is that do not come up with a regulatory framework that prohibits pension funds into investing in the sectors which are high emission sectors where we can help the companies to transition to clean energy. So if we just all divest from these companies, it will not have any impact on the actual emissions. And that is really a concern. It's with all the impact investing that if we look at the ratings, the data, there are so many different, they all have different assumptions and they all contradict in the end each other. So even if you are an impact investor, you can have other impact investors who have different goals, and they cancel each other. And there's also scientific studies or academic studies looking at this, that we really have to have consistent, aligned rules that actually help the transition when you really go as an institutional investor down the road in ESG investments into impact investing. The regulatory framework has to support that you actually have an impact, that you actually can transition the companies where you invest in.
Thank you very much, Matti. Very, very interesting. And I wanted to insist on that so that everybody understands the complexity of such a transition process, where it's not that it's not a mathematical exercise. It's not A or B or 1 or 2 or 1 or 0. It's a little bit of everything. And so that makes it indeed very difficult in practice. And then I want to move to the rating agencies, because of course you're faced with that. And what I wonder about is how do you ensure that, although you don't rate ESG of companies, because that is not your role, you have a different role, but you do rate these ESG factors. And so the question is, how can you assure that we have a comparable approach, that what AM Best is saying is the same as Fitch? How can we be assured of that? And coupled with that, I would also be interested in knowing not only this comparability, but also the question of how does that impact the solvency rating in the end?
Yeah, absolutely.
Could you clarify that, and welcome to the panel.
Thank you very much. So first of all, I want to clarify the ESG rating and credit rating difference, and we embed the ESG factor in our rating, but we do not score ESG and we do not assign ESG ratings. Other agencies offer ESG ratings. It's a completely different framework in terms of regulation, supervisory, and we believe that the two frameworks, ESG ratings and the credit ratings, are fundamentally different. There is a new regulation ongoing that will add more formalization, regulation, and hopefully also supervisory from ESMA, and this will be a step forward in terms of comparability. But as of now, the ESG rating framework is not very good in terms of comparability, because there is a clear lack of a comprehensive framework, let's say. But this new regulation will definitely improve it. So we think that in the ESG rating framework there are key aspects that are missing from a regulatory standpoint. For example, transparency, conflict management of the conflict of interest, and the disclosure. So the ESG framework is still evolving. The ESG rating, framework is still evolving, and as of now, the comparability is very difficult. So this is why, in terms of correlation between the ESG rating and the credit rating, a bad ESG rating doesn't affect our credit rating, because we do not take into account ESG rating provided by third-party providers. So we embed in our analysis our view on the ESG factors of a specific company, and we do not look at ESG ratings provided by other agencies. So moving on a more investment side, since the topic of the panel was more investing, I will link myself to what Matti was talking about, transition risk. In our methodology, we specifically include transition risk among the factors that we take into account, and specifically the exposure to stranded assets. And also here, I would like to highlight also a difference between our framework of the credit rating agencies in which we operate and the framework of the ESG ratings, which is the fact that our rating process is interactive. So We discuss with the company. We have access to non-public information. We ask them to submit a questionnaire. So, for example, if we want to analyze the transition risk in relation with stranded assets, we have a full, clear view of the investment portfolio of a company because we have access to non-public information through our process. So we analyze the level of exposure to stranded assets, and we understand if that's a risk. And just to clarify, stranded assets, I mean assets that may suffer impairment, write-downs, or devaluation because of changing regulation or consumer sentiment following the transition to the low-carbon environment. So, to sum it up, we do not take into account ESG rating provided by other third-party companies, but we embed ESG factors in our assessment. And the lack of ESG practice does not trigger a negative pressure on the credit rating by itself, but we mostly are interested in secondary effects, like, for example, the stranded assets may impact the balance sheet strength of a company, so affect their credit rating fundamentals and therefore the credit rating.
So, if I understand you correctly, if you would do the ESG rating for the investment of the insurer, and if the investment would show a very bad rating, it would still not affect the credit rating of that solvency of that insurance company.
I wouldn't call it a rating, investment rating. You said investment rating.
Yes.
But no, we don't do a rating specifically on the investment. We do a credit rating on the overall financial strength of a company, and within this assessment, we take into account some specific ESG factors, but then we don't rate specifically the ESG practice of a company.
Okay.
Okay.
It's a little bit complicated. That's why I wanted to clarify it. But let me further complicate the issue.
Please.
There aren't that many credit rating agencies. So when AM Best is doing this assessment, whether you're based in Madrid, in The Hague, in Brussels, in Paris, in Tokyo, are you applying the same methodology in the ESG rating?
In ESG rating, there is a lack of methodology. So,
okay.
yeah, in credit rating, no, it's different.
No, we don't talk about credit rating.
No, ESG rating, I don't even think that there is a uniform methodology framework as of now. So there are many different agencies that offer ESG ratings. Each one has its own methodology. There is lack of comparability. There is lack of disclosure. And so overall, that's why I and AM Best, I speak for AM Best, of course, it's not my personal opinion, there is a lack of comparability. And so because each ESG rating agency has its own methodology, and so they differ. Yeah.
But within AM Best, it's the same.
Within AM Best, it's the same. Yeah,
that's what
absolutely.
I wanted to know.
Absolutely.
So that you
within
get the
AM
same.
Best, yeah.
Okay.
The way we in Amsterdam assess ESG factors within the EU companies is the same as the US office assess the US companies' ESG factors.
Yeah.
Yeah. Our methodology is the same.
Yeah, because on the credit rating, of course, you have developed these solvency models, which are also applied throughout the world. So, ladies and gentlemen, we are approaching lunchtime, but nevertheless, there may be somebody in the audience who says, this is something I really need to ask. A short question.
I promise, Karel, I promise.
Thank you.
Today it was several times mentioned that there are not enough sustainable investments in the market. We have some opportunities also in the Solvency II regime concerning infrastructure, and now with the Solvency II review, long-term equity. What's the role of the investment firms to bring those together? For example, governments who need the money for infrastructure, for public traffic, hospitality, and so on, and the private investment companies, as insurance companies, to bring those together who need the money and who have the money. What do you think you have a special role to bring the both together? Thank you.
So, gentlemen, what do you think? Klime.
I can share the recent last year experience in the two countries, Serbia and Macedonia. Based on the dialogue between the financial institution in both countries, for the first time, the two governments decided to issue green bonds. And they were very successful. And the green bonds were the most bought by the insurance companies. Now, what is our responsibility, and the government's responsibility, to watch, to monitor if those money really goes to the green projects. Exactly. This is very important, because sometimes the government will learn from some other country's experience. It's a kind of greenwashing. They will have very nice catalog explaining the green bonds, but in the end they will fill some gap in the budget. But our responsibility, I would say, it's to really close monitoring the spending of this money. And for example, my company that, and of course with the permission of our shareholder, our parent company, VHE, we put as much as possible to have exposure to the government bonds in buying the green bond. And as I said, this emission was based on the initiative that comes from all financial institutions, and we have open dialogue with the government, and it was successful.
Okay, Matti, do you want to say something to that?
I mean, for pension funds, I think green bonds are available, and many other investments in Europe as a whole. I think in ESG investments there are a lot of opportunities and funds. So I think it's quite developed in many European countries. I was just thinking about this greenwashing and pushbacks. You also mentioned in this discussion in the US, there's pushback, especially from around 20 states now already prohibiting using asset managers that use ESG criteria, and the same asset managers are managing the pension fund money as well, also European pension fund money. So it's an interesting situation where the same manager has to be, I'm not doing anything in ESG, yes, I'm fully in ESG at the same time. Yeah. So I'm sure in Europe also greenwashing issues, there's some pushback as well, but not to the same extent that in the US. But that's why I wasn't thinking of the question, I was thinking of what people were saying. So yeah. So those are, I mean, it's relevant to the political side of this, and then of course, like how politicians interact with this. The international pension supervisors have emphasized the fact that even with the public pension funds, the governance should be free from political interference. So really, the pension money should be kept outside the scope of political decision maker.
Good luck with that.
Good luck, but that's a valid aim that should be done, and it really relates to this whether money is actually used for ESG purposes or not.
Andrea, you have any comments?
I would just comment that I think that specifically for the clients that I interact with, I didn't hear much talking about the lack of investments, of green investments, lack of availability of green investments. But I think that the transition is a transition. It's slowly proceeding because, again, linking to what Matti said before, because he said a couple of comments that are very close to what we think. It's a matter of risk and return. Green investments offer sometimes lower return, but better risk management. And so companies are transitioning their assets portfolio to green bonds, balancing out this maybe lack of profitability, but benefit from risk management perspective. So I think this is the most important conversation ongoing in terms of in investment management in insurance companies.
Okay, thank you very much. Well, ladies and gentlemen, with that, I would say let's thank the men of the panel.